What is going on, traders? With a correction in the S&P 500, an almost bear market in the NASDAQ, is the bloodshed over? Obviously, all of you are asking this question. This is the most common question that I see right now. And more importantly, what is our plan for February? With earnings season coming up, I thought that good earnings from Apple, Microsoft, Google would be enough to uphold the market. And we are seeing a really nice bounce back. But we are not out of the woods just yet, and I will get into why that is. If this is the first time on the channel, welcome to The Traveling Trader. If you get anything out of this video, leave it a thumbs up. Let's get right into it. All right, so as I stated at the outset, the S&P 500 officially hit correction territory, hitting the 300-day moving average. We obviously bought the S&P 500 at the 300-day moving average. We bought Google when it hit the 200-day. We bought Microsoft when it hit the 300-day. If you want access to all of our trades, link is in the description below. Now, buying those does not mean that that is the absolute bottom. It could be, but that's not the intention. And I'll get into why that is when I get into our plan for February. Everything will be in the chapters below, so feel free to forward and rewind as you like. But you definitely want to stick around till the end because that's when I will go into the trades and our plan. Now, obviously, this bounce coincides with the Fed meeting at the end of January, which we covered extensively on this channel, both in the videos as well as the live streams. But basically, the gist of it is that everything that the Fed is going to throw at us is already priced in. We already know this. We know about the Fed rate hikes. We know about the tapering. They were a little bit vague about selling assets off of the balance sheet. So that is still kind of an unknown, but we know it is coming. If they do announce it, it's not going to be a surprise. So the bloodshed from the Fed anticipation, I think, is already priced in here. Now, just because there isn't a particular reason for a drop, that doesn't mean there's a reason for a rally either. In a high interest rate environment, in a high inflationary environment, in an environment where we have extremely low supply that does not meet the demand levels, in an environment where we have now lost 301,000 jobs, the biggest shed since the start of the pandemic, the environment itself may not be conducive for a sustained rally in stocks. That does not mean we're going to tank, hit a bear market, hit a recession. It just means that there aren't enough positive catalysts, in my view, for there to be a sustained rally. There is one doomsday scenario that I talk about all the time. If you're a fan of this channel, you know what I'm talking about. And that is called demand destruction. Now, demand destruction is defined as a permanent downward shift on the demand curve in the direction of lower demand of a commodity, such as energy products, induced by a prolonged period of high prices or constrained supply, both of which we have. So it's not an or, it's an and in this case. And this is an environment that we haven't seen for a very long time. You have to go back to the 80s to spot an inflationary environment similar to what we have today. At the Fed chair at that time, Volcker, was a lot more aggressive than Powell was because he did not care about the markets. He was like, let's fix inflation first and then the markets will follow. And that is not what we're getting from Powell. So until the Fed starts implementing their plan and acts a little bit more aggressively, I do think that the market will continue to be in this high volatile phase. When you take a look at the VIX here, the VIX is still trading above 22. And as I've stated in previous videos, we want the VIX below 20. Because the VIX is the fear gauge index. So it basically tells us how scared the markets are. And above 20, there's still a little bit of uncertainty there, right? The VIX is the fear gauge index that is computed based off of the activity that's going on in S&P based options. So when the fear gauge is higher, that typically means that investors and institutions are hedging more, betting against the market, because either they think the market is going to drop or they are hedging their long positions on stocks that they own. If you look at 2020 during the Rona, that's where the VIX was routinely above 20. And that would make sense because that was a time of high uncertainty before the vaccines. We didn't know the extent of the virus, et cetera. So the fact that, all of 2021, for most of 2021, we were routinely trading below 20. And now we, in 2022, have not been able to sustain a level below 20. So the market is still very shaky at the moment. So in summary, here's what I think the markets could do. As of the time of this recording, we don't have a ton of mega cap tech earnings left. We have Facebook and Amazon, as well as Qualcomm to a lesser extent. But most of the mega cap tech stocks, they had blowout quarters, the best quarters ever. Microsoft, best quarter ever. Google, best quarter ever. Apple, best quarter ever. But if we take a look at the S&P 500, it notoriously and routinely does what is called a W-shaped pullback or a W-shaped correction. I highlighted all the times since the Rona drop of 2020, and you could see how many times it does this double dip correction or double dip pullback. It is very routine for the S&P 500. You could see here W-shape, 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 etc. So I would not be surprised that after the mega cap tech earnings are released, fully released, right after Facebook and Amazon report, that we see somewhat of a double dip correction. Now, exactly what that looks like, nobody can tell you, but I would not be surprised to see that because the S&P routinely does this. And as I just stated, just because there isn't a catalyst for a major drop does not mean that the market environment is favorable for a sustained rally just yet. Hopefully that makes sense. If you have any questions on this, leave it in the comment section below. Would love to hear from you, and I try to answer every single comment. All right, now the fun part. What is our game plan for February? What stocks are we buying? Well, it's actually really simple and probably exactly what you think. When you look at mega cap stocks, quality stocks, not high beta stocks. We're not talking about the DraftKings and the Fubo and the Skills and the QuantumScape. We're talking about the stocks that you know I'm talking about, right? Microsoft, Apple, Home Depot, McDonald's, Amazon, etc. You want to buy quality stocks and fill your portfolio up with them on the dips. And I was saying this for months now, right? This right now, this type of correction is an opportunity for you to rebalance your portfolio, in my view. We are not bottom hunting here, but remember, the market is the only sale in town where buyers don't line up. Everyone is so afraid to buy, Microsoft at the 300-day moving average, but once it starts climbing back above 300, they ask, is it too late to buy? Same thing with Google. I mean, even in our Discord group, right? I put out an alert for Google back when it hit the 200-day moving average. It now announced a stock split, hit above 3,000 all-time high today. And the number one question that I got this morning on the Discord, is it too late to buy Google, or is Google a buy here? Well, it was a buy, back when it was trading at 2,500 just a few days ago. It was not that long. So the plan is simple. When you see blue chips at a discount, during this time, you start accumulating them for the long term because you don't invest for the long term using a swing trader's mentality. If Facebook drops after earnings, I'm going to pick some up. Microsoft was in a bear market. This is a company that reported a $51 billion quarter, was in a bear market at 274. I'm going to pick some up. I mentioned this before, but you don't need to reinvent the wheel. The S&P 500 at the 300-day moving average is a buy no matter what. If you go back to the history of the S&P 500 at any single point in time, and if you bought the S&P 500 at the 300-day moving average, you would, in the long run, have always made money. Always. Now, obviously, the situation is different if you're going to retire in 2 years or in 5 years, but I'm talking about long term here. Same thing, that the NASDAQ almost hit a bear market, just a couple of percentage points shy of a bear market at the June 2021 levels. Everyone asks, oh man, I wish I had the opportunity to buy cheap stocks. When are we going to have that again? Well, we already had that. So the point is, I don't mean to keep beating on the drum because you guys might get sick of that, but buy high quality stocks at major discounts for the long term. If you want to learn how to swing trade, then swing trade, but don't try to long-term invest with a swing trader's mentality. All right, now in conjunction, I also have hedges in place. Now, there are a few ways to hedge. Remember that cash is also a hedge. It does not mean that you have to blow your whole wad at one price point. You can keep some cash on hand as a hedge for sure, but remember that if you're trying to time the market, most of the time you will fail. Remember that time in the market beats timing the market, and the best 10 days usually occur during corrections when most people have pulled out and capitulated already. Also remember that corrections rarely turn into bear markets historically, and buying an S&P 500 correction usually results, in terms of a median outcome, in a 15% gain over the next 12 months. And here is what a NASDAQ correction looks like based on historical data. Usually, the NASDAQ recovers fully within a short amount of time, and we are back into extremely green territory 3 months to a year after that correction. One other way that I'm hedging is by buying SPY puts. You could see here on CheddarFlow, this is the tool that I use to track options flow data in real time. If you want a discount on this, a 25% discount, use the code TT32 at checkout. You'll see the link in the description for CheddarFlow, but basically, I will be buying some puts on the S&P 500 because I have a lot of S&P 500 based stocks. You can see here that the 450 puts expiring February 22nd and the 445 puts expiring March 18th have an insane amount of premium, meaning that insiders and institutions are buying these puts as hedges or even straight out bets that the S&P 500 is going to drop in the short term. So along with buying stocks on the dip, I also engage in put buying to offset any downturns that I experience from buying those dips. The amount that you hedge is completely up to you, but say your portfolio is worth $10,000 and you wanted to hedge 5% of it, well, then you would engage in put buying up to $500. If you wanted to hedge 10% of it, then you would up that to $1,000. And for those of you that are new to options, remember that when you buy an option, you can't lose more than you bought it for, right? So I know that there's this fear that, you can lose more than the money that you allocate for buying puts or calls. That is simply not true. You start getting into trouble when you talk about selling or multi-leg strategies. But if you're just outright buying a put or a call, then you cannot lose more than the amount of money that you put up for that put or that call. But do your own research, paper trade, read up, learn how to trade options. There are tons of free videos. There's also a course below if you are so inclined. But hedging is a must, in my opinion, especially during high volatility environments where there's a lot of uncertainty. And lastly, if you don't want to trade options, there are inverse ETFs. So there's the SPXS, which is a bear ETF against the S&P 500. There's also the SQQQs, which is a bearish ETF against the NASDAQ. Now, I would caution against holding these. These are very short-term plays. I personally don't prefer them, but for those of you that don't want to engage in any sort of options trading and you are just looking for inverse ETFs that you can buy into in the same way that you buy a stock, those are some examples and some ideas for you. Again, that is not the route that I take, but to each their own. Anyway, traders, hopefully you got some benefit out of that market update. As I said before, just because there isn't a catalyst for a complete market crash does not mean that the conditions are favorable for a sustained and strong rally either. I personally will not feel comfortable about a sustained rally until I see the VIX below 20 again and until the Fed starts actually implementing what they said they would implement. We do need to get inflation under control. That is not a joke. The Fed really needs to stop fucking around and twiddling their fingers, because inflation is going to cause a lot of Americans hurt, in my opinion. If you got anything out of this video, leave it a big fat thumbs up. If you want access to all of our trades, link is in the description below. All of our hedges, options, long-term investing, crypto, etc. Link is in the description. Would love to have you. Come be a part of the community. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.